and good morning to everyone. Today's speaker is Roberto Chang. His talk is titled Hawks versus Doves, U.S. Macroeconomic Perspectives for 2022. Roberto is a distinguished professor at Rutgers University and a research associate at the National Bureau of Economic Research. Previously, he was an assistant professor at New York University and a research officer at the Federal Reserve Bank of Atlanta. He has also served as a visiting faculty member at Princeton University, Columbia University, and the London School of Economics and Political Science. Professor Chang has published extensively on monetary economics, exchange rate policy, and financial crises. He has been an editorial board member of the Journal of International Economics and the Journal of Development Economics, a member of the economics panel of the National Science Foundation, and an advisor and consultant for financial and policy institutions, including the IMF, the World Bank, the BIS, and the Inter-American Development Bank. He is a native of Peru and holds a PhD in economics from the University of Pennsylvania. And he lives in Westfield, where I live. Anyway, I'm very honored to present Roberto Chang.
Well, thank you very much for that gracious introduction. Thank you for the invitation and the opportunity to speak about macroeconomics and the prospects for the United States economy and the world, especially to my good friend Arch. And I'm going to say that I am very impressed by the group, and I hope that you find this talk, I guess, amusing, if not useful, since you actually start with some kind of like humorous segment. I don't know if I can match that, but I'll do my best. And let me just go to a series of slides that I want to share with you, right? I mean, when Arch and I agreed to have this talk, I anticipated this was several weeks ago. Of course, there was no way to know where we would be at this juncture. So I told him, look, we're going to talk about perspectives in 2022. And what I had in mind is, well, maybe at least, today, for example, as you may or may not know, the Federal Reserve starts a two-day meeting where they are probably going to talk about the prospects for the American economy and what is going to be the program for monetary policy going forward. And as Arch mentioned, I used to actually work at the Atlanta Fed. I was there for 7 years, and I learned to actually how these discussions actually might go. And I learned that each time you want to talk about, say, the State of the Union or prospects for the United States, I guess the best thing to do is to keep in mind, a particular motto, if you want, which is I remain optimistic about the future, but remain cognizant of the downside risk. Right? This is something that we always kept in mind. It was back in the 90s, and it became like a kind of an insider's joke that was going to go in the tombstone of our then central banker, right? Okay, so let's start with this discussion about what is to be what we can be optimistic about and what is the downside risk. So I actually see a lot of reasons for optimism. This is something that may come as a surprise given the very hard 2 years that we've lived since the start of the pandemic in the United States and the world. But I'm going to say that after all, I guess as an economist, I always want to think about what could have been and how much better we were relative were, given what happened to us. Okay, so the pandemic, for example, has been the central aspect of our lives for almost 2 years now, but in spite of the recent very quick spread of Omicron, then that danger turned out to be actually not as deadly as we had feared or could have been. And when you think about the situation, say, even as late as a year and a half ago, then the range of possibilities at that time, I'm talking about the fall of 2020, there was a lot more uncertainty about, for example, where the pandemic was going to go. For example, at the beginning of the fall of 2020, say September, October, it wasn't even clear that a vaccine was going to be developed in time, an effective vaccine. And then in November of 2020, the most effective vaccines were announced. So in that sense, you can actually say that there was not only a stroke of luck, but also a triumph of modern science to be able to develop these very effective weapons against the pandemic in a really record period, right? I mean, from the beginning of the pandemic to when the Pfizer vaccine, for example, was approved and distributed, then you have like less than a year. I mean, that, by all standards, has to be a big triumph. The economy tanked in the United States and elsewhere in the world, right? Everywhere in the world, really, around March, April of 2020. But you can see that it has been surprisingly resilient. I mean, the danger at the beginning of the pandemic, I'm talking about March 2020, April 2020, would have been a complete meltdown, for example, of the financial system, which did not happen. Right? Something that could have happened, similar to what we experienced in 2008 and 2009 after the bankruptcy of Lehman Brothers, for example, did not happen. And it did not happen because I think central bankers around the world, not only the Federal Reserve, but also the European central banks and a number of other central banks, they had learned the lesson of the global financial crisis, and they reassured financial markets and institutions that enough liquidity was going to be furnished as it was needed in order to prevent any kind of financial crisis. And in fact, the financial system did extremely well, much better than people would have anticipated at that time, right? Fiscal policy in the United States was also very expansionary, right? That also was a lesson that was learned from the previous crisis, the financial crisis, and surprisingly so. I mean, for example, incomes in the United States were even there was no contraction in 2020, right? In fact, there was incomes grew in 2020, and they have continued to grow, in 2021. Okay. So about the pandemic, for example, you can see that there is a lot of discussion about whether the Omicron variant has run its course. And in my view, I've done some work on the relationship between the pandemic and macroeconomics. In my view, then it is clear that we are on a very quick and downward trajectory. I mean, this is, for example, the most recent graph for New Jersey. I mean, if you go to, say, the CDC or the New York Times, then you can see the numbers, right? The number of cases relative to last winter's peak increased by 400%, more than 400%, because of Omicron, but also they have decreased quite dramatically, right? So at this point, I think the number of cases is not larger than the peak a year ago, okay, in spite of the much more contagious nature of the Omicron variant. So this is reason for optimism, in my view, and this is one reason why, for example, the economy should be expected to continue moving along very strongly. And what am I talking about here, strongly? Here, for example, you have a graph of GDP, gross domestic product per capita in the United States. And you can see clearly that, obviously it tanked during the pandemic. I mean, here, the gray bar indicates what is called the National Bureau of Economic Research recession time, right? So this is essentially the second quarter of 2020. And you can see that having grown quite strongly until the pandemic, then there was a huge decrease in economic activity. But since then, the recovery has been quite dramatic as well. I mean, if you look at the end of the period, then not only it has surpassed the previous peak, but also it has almost caught up with the previous trend. The unemployment rate, of course, essentially followed the same trajectory. I mean, you can see that in 2000, I mean, in fact, before the pandemic, the unemployment rate had fallen to about 3.6%, right? From, say, being close to 5% 3 years prior, right? But then between March and April, it shot up to about 14.6%, as I remember, right? Very fast. Now, however, since then, the unemployment rate has essentially gone back to its previous very low level, right? So, in other words, you know, and you of course hear that the labor market is very strong. Right? This is reflected also in it has been reflected on a number of statistics, including wage growth, for example. And here, this is a graph that I took from the New York Times recently, and it shows that since 2019, essentially wages in all industries have grown on average about 15%. And of course, you may have heard that, for example, if you look at sectors like leisure and hospitality, the growth rate has been much faster, right? I mean, here, the leisure and hospitality sector shows growth in the last 2 years of about 20%. So there is a number of indicators that tell us that in spite of the pandemic, the overall economy has been doing very well, right? I'm not saying that there are no problems and there is no particular groups that have been hit very hard by the pandemic. I mean, there's clearly a lot of heterogeneity, and a lot of sectors have suffered a lot. But you know, on average, the situation has been surprisingly resilient. But of course, we want to recognize what is the downside risk. And here, the risk is the specter that is haunting the world: inflation. The last reading of inflation, as measured by the year-to-year increase in the consumer price index, it shows inflation of more than 7%. And what is more, I guess, worrying in some sense is that inflation has been accelerating. Right? I mean, this is actually probably best illustrated by looking at the graph of inflation. Here you have essentially the year-to-year change in the CPI. So this is a measure of inflation in percentage terms. Essentially, since 1965, we are going to go back to that graph. The dark line is the CPI change, and the gray line is the consumer price index, excluding food and energy, what is called sometimes the core CPI index, right? And you can see that in December, the inflation rate increased by 7%, the core CPI increased by 5.5%. And to give some perspective, you know, this increase in the CPI is the biggest we've had since the 80s, right? I mean, you had to go back all the way back to 1982 to actually see an inflation rate that large. And of course, you know, what scares people is that you know, in the 80s, inflation actually continued growing past 7%, right? You can see that inflation actually in this graph reached almost 14%. So what is it that I am worried about, or people are worrying about? Of course, the question is, what are the consequences of this situation, right? And of course, that depends on who you ask, but obviously, financial markets are very worried, right? I mean, you can see, for example, that in the behavior of stock prices. Stock prices were very strong in 2021, but since the beginning of the month, there has been close to what sometimes it's called a correction in stock prices. I mean, here, this is a graph of what has happened since January 3rd, right? This is a daily number. This is a daily graph for the S&P 500 or the NASDAQ Composite and the Russell 2000, different measures of stock prices, but they all show that since the beginning of the year, essentially, there was a decrease in stock prices that has been something between 10 and 15%, right? You may have heard that yesterday, actually, there was a big drop, and then by the end of the day, the stock prices, the Dow Jones actually ended up higher than at the beginning of the day, but during the day, it had dropped by almost 4%. So there is not only a trend towards stock price losses, but also a lot of nervousness as expressed in volatility in the markets. Not only that, I mean, right now, for example, there are complaints that, okay, so for all the wage growth that we have, then inflation is going to eat away all of these gains, right? I mean, here, this is the main editorial of the New York Times on January 22nd, 3 days ago, saying President Biden's economy is failing the Big Mac test. What did they mean? It meant that, okay, so it is true that wage growth has been fast, but not fast enough to even compensate for inflation. So inflation turns out to actually eliminate all of the wage gains that we had seen in the previous graph. But interestingly enough, how much you're worried about inflation seems to be correlated with your age. And I think that for a good reason. I mean, this is a good graph, a very nice graph that I found as I was essentially preparing for this talk about inflation forecasts of different age groups, right? So in this case, for 3 groups, under 40, 40 to 60, and over 60, the graph shows forecasts of inflation, where these groups expect inflation to be in 3 years. You can see that younger people think that inflation in 3 years is going to be something around 3.5%. People over 60 expect inflation to be something closer to 5%. It's interesting because, of course, it reveals or tells me, who may be more exposed to inflation in this case. I mean, people that are, for example, retired and living in, say, fixed incomes or pensions or even stock prices may be more affected by inflation in their rather than younger people. But also, it matters that people over 60 have the memory of the previous important inflationary episodes in the United States. Of course, people under 40 do not remember those episodes. So it's actually, it will be good to actually review what those episodes might suggest. So let's actually think about, in doing that, keeping an eye on what these episodes tell us about the dangers of trying to bring inflation down, right? I mean, these episodes tell us that, in fact, as the joke says, the answer is very carefully, right? We have to, it is a very dangerous process to bring inflation down. And I'm going to try to be specific about what I mean, right? I mean, here, going back to like the post-war era, I mean, this is the behavior of United States inflation. I mean, again, this is the CPI year-to-year change monthly since essentially the beginning of the series, which is the beginning of 1948. And what people under 40 essentially lived was a period where inflation was already under control, right after 1982. It's actually quite dramatic in this case. I mean, people under 40 have actually lived not only a period of very low inflation. I mean, here, after 1982, inflation has never been over 5%. And in fact, it was on a declining trajectory for the last 4 decades. You can see that very clearly in the data, right? Of course, people that are somewhat older, and that includes myself, may remember, the period before 1982, right? And where inflation actually increased constantly from about 1.5% on average to like 14% or more by the end of 1981. Sorry, this would be the around 1980, right? And then some people actually see parallels between that period and the most recent run-up in inflation, right? So why is this a main concern then? Well, because of course, inflation in the 70s and 80s, whose origins were, for example, the oil shocks of the 70s, but also expansionary policies by previous administrations. Right? The concern is that at some point, the central bank or the Federal Reserve will have to act in order to bring inflation down, and then the more it waits, the more drastic the measures will have to be. Right? So this is a graph of the unemployment rate in the United States during the same period, right? Again, the gray bars give us the US recession times, right? And you can see that essentially in the period where inflation shot up, essentially unemployment also started increasing in the United States. I mean, at the beginning of the 70s, unemployment was something between 5 and 6%, right? By 1982, by the end of 1982, unemployment had increased to more than 10% in the United States. In subsequent periods, unemployment remained much lower than that, except for the global financial crisis. I mean, and here we are talking about the period around 2008, 2009, and of course the COVID crisis. But in both cases, the unemployment rate actually fell for other reasons. In the 70s and 80s, the way to bring inflation down was essentially at the end to implement very drastically contractionary monetary policy. And people of my age, for example, might remember the period between 1979 and 1982 in which interest rates were brought up. I mean, here this is a graph of the policy interest rate of the Federal Reserve, what is called the federal funds rate of interest. This is the rate of interest that banks charge each other in the interbank market, right? And this is essentially the interest rate that the Federal Reserve essentially has been arguably targeting with its policy instruments. except in fact between 1979 and 1982, where the Federal Reserve actually switched to what is called a quantitative target, right, for the money supply, with the implementing what was called the Volcker deflation, right? In this case, because of the name of the chairman of the Federal Reserve, Paul Volcker. Okay? And then the Volcker deflation was based essentially on restricting the growth rate of the quantity of money, which actually meant that interest rates were allowed to go as high as close to 20% in the case of the federal funds rate, right, and higher rates for other interest rates. So this was a very drastic move that again precipitated what was behind the huge increases in the unemployment rate, right, around the time. So this is the situation, and given the current increasing inflation and the diagnostics, then I guess people, investors, economic agents are starting to realize that the Federal Reserve will have to take action sooner than later. I mean, here, this is a very nice graph from the Financial Times talking about what were the projections of that were in fact published in FOMC documents, the projections by members of the FOMC, that is members of the Board of Governors of the Federal Reserve and regional presidents of central banks, right, about where interest rates were going to be in the next 2 years and in the longer run. So you can see that the projection for 2022, this is the projection as of December 2020, so a year ago, a little more than a year ago. Essentially, all of these monetary policy decision makers were projecting that interest rates would remain close to zero this year. This has changed, obviously, right? Now, as of December of 2021, the projection of the same policymakers has changed so that essentially the I guess the median forecast of these decision makers is that interest rates will go up to 1%, and then they will continue to go up to closer to 2% by the end of 2023. So what these decision makers seem to be saying is, well, we have changed our views about the American economy, and in particular on what we have to do about inflation. And we actually essentially are expecting that we are going to be acting accordingly. And this is actually what has, in some sense, changed the perspectives of the markets, right? I mean, you can see here, this is the behavior of the stock prices since a year ago, January of 2021. Right? Essentially, the stock prices increased by more than 20%, but at the end of the sample, you can see that stock prices have essentially tanked. Now, there is one more complication in this whole picture, which is significant, which is that the Federal Reserve has been essentially supporting both, essentially debt markets, treasury securities and mortgage-backed securities, right, to a very large and impressive extent. So this is the graph starting in 2000 of the size of the portfolio of assets purchased by the Federal Reserve. I mean, you can see here, around 2008, before 2008, essentially the portfolio of assets was something in the neighborhood of $800 billion. With the global financial crisis of 2008, the portfolio essentially more than doubled, almost immediately. I mean, this was necessary for the Federal Reserve to support essentially mortgage markets, which were behind the global crisis of 2008-9. But then the size of the Federal Reserve has continued growing. I mean, you can see that in around 2017, the Federal Reserve made the decision to try to shrink it a little bit. But with COVID, in fact, it has continued growing, right? I mean, you can see that around the start of the pandemic in March of 2020, the portfolio was about a little more than $4 trillion. By now, it is more than $9 trillion. So as the joke says, you know, a million here, a million there, and all of a sudden you're talking about real money. I mean, $9 trillion, when you think about what has happened in the last, say, 12 years, the portfolio of the Federal Reserve has multiplied by 10. Right? So this is a huge increase. And much of it has happened since March of 2020. The portfolio of the Federal Reserve since March of 2020 has more than doubled. And the same has happened with the federal debt, right? I mean, you can see that this is the graph of the government debt in the United States as a percentage of GDP. Before the global crisis in 2008, it was something in the neighborhood of 60–70% of GDP. In order to try to act against the global crisis, the debt increased to about 95% of GDP. And now with COVID, it has increased to almost, according to this graph, to more than 120% of GDP. Of course, you know, this is actually the way in which the federal government has financed some of the emergency support measures due to the pandemic. Nevertheless, you know, it is, one has to recognize the, that those emergency measures and the way they have been financed actually have created a potentially very fragile situation in terms of there is a lot of liquidity out there that presumably is behind the very strong performance of, say, stock markets. And also now it's also behind inflation. And talking about which, you know, there has been, what you want to say or what you believe about what has to be done depends to some extent on what you think is behind inflation. And here there has been, for a few months, this discussion about whether inflation responds to transitory aspects of the economy, especially those that have been caused by the pandemic, or to permanent aspects of the permanent shocks. And, you know, in fact, there was, you know, this confrontation between what's called team transitory versus team permanent. I mean, team transitory advocates were essentially a number of people sympathetic to the economic position of the administration, including Paul Krugman at the New York Times, who is presumably the most prominent member of the team. And even until very late, December 10th, he was arguing, well, you know, it's not clear that actually inflation, the inflation run-up has been, is a source of concern in the longer run, right? For example, he will say, look, you know, a lot of the inflation that we have seen responds to disruptions in the supply chain. You may have heard that, you know, international trade has been interrupted because of problems with shipping costs and, say, now more recently, lockdowns in China and so on, right? But, you know, those factors may have peaked. I mean, here, for example, you have data from the Bank of International Settlement saying, well, you know, the index of shipping costs, which indeed went from about 100 at the beginning of the pandemic to more than 700 in the third quarter of 2021. Now they have actually like fallen something, right? So from 700, more than 750 to 600 in the red line, or from 450 to less than 300 in the blue line. So different kinds of indices. So there's the hope that, as the COVID situation normalizes, then this supply aspects of the economy are going to subside. And therefore, the implication is, well, maybe there's no need for a very forceful monetary policy aimed at reducing inflation. Not so would say somebody like Larry Summers, for example, people that align themselves in terms of what has been called the team permanent, right? Team permanent would say, well, what has happened really is that the economy has been doing very well, in fact, too well from the viewpoint of inflation. And that has brought essentially economic activity past what is called the non-inflationary level of output and income, right? And therefore, you should have expected actually inflation to take off, right? How to think about this? To me, it's not about permanent and transitory, but at the end, it's really like a simple story of supply and demand, or what macroeconomists talk about, aggregate supply and aggregate demand, right? And I think that, I think when I look at the situation this way, one team is clearly the winner in this game. If we think about the most crucial factor as not being temporary or permanent, but supply versus demand. What do I mean? Take the position that inflation is being caused by supply shocks, then that's in fact the position of team transitory. They are saying that inflation today is largely the response to temporary supply disruptions. Right? Well, what do we know about those? We do know that these kinds of supply disruptions, like shipping problems, or even scarcities due to lockdowns and whatnot, they can in principle cause an inflation surge. Right? However, those same shocks at the same time would cause an overall detrimental impact on economic activity, right? So the best example here would be the situation in the 1970s, when there was what was called stagflation because of oil shocks. Inflation in the 70s was is largely attributed to the essentially at the time the quadrupling of oil prices, right? But that also that caused inflation, but also at the same time a recession in the United States and increasing unemployment, and the numbers that we saw that people are concerned with these days. Right? That's why, in fact, the period was called, was termed stagflation. Right? So, what's the problem then with team transitory? Well, to me, the problem is that growth and employment, as we have seen, have been quite robust. So it's very hard to actually assign the dominant role in the surge of inflation to supply shocks. What about demand shocks? Here the story is that there have been some factors that have meant that aggregate spending has increased. Those are like just direct fiscal expenditures, and then transfers to the population in terms of, say, sending checks to people so that they continue consuming, enhanced unemployment benefits, And also on the monetary side, the very expansionary, accommodating policy of the Federal Reserve as given by zero interest rates, for example, or as we had seen, like a continued program of purchasing assets by the Federal Reserve. Okay. So in that sense, this strong aggregate demand, aggregate expenditure situation is the outcome of macroeconomic policy stimulus, both on the fiscal side and the monetary side. And that kind of explanation, one that relies on excess spending, would be consistent not only with an increase in inflation, but also the strong real economy. So you have to actually say at the end that this kind of explanation has an easier time conceptually, theoretically, and empirically explaining, both the fact that inflation is surging and the economy remains strong. So this is the situation. I think that the game is not over yet, but it's clear to me who has the advantage. Right? And I think that the Federal Reserve has come to terms with that analysis. Let's see, there is somebody that wants to ask a question. Pastor Canton. Yes, go ahead.
Well, we actually we'll defer the questions till the end.
Okay, all right. So yeah, I'm almost done. So in December, the Federal Reserve actually announced that there would be, presumably, they expected to increase rates at least 3 times. Now I think, but by now, I think today, that number is going to go up. That will be my expectation and the market expectation. Also, I think the government itself has changed its position, right? I think that there's not much to be said given the situation. Given time, I'm going to actually skip this part of the discussion. Just go to what the implication for policy might be. I mean, what does the analysis mean by policy then? Well, if we agree, as I think that most of us are, that inflation is reflecting excessive spending, mostly, not only, but mostly, there's no question that monetary policy has to respond by raising interest rates. Before, and sooner than later. Sooner than later, meaning that if there's too much delay, the inflation starts being incorporated into people's long-run expectations and contracts and whatnot. So, but also there are implications for fiscal policy as well. Keep in mind that a lot of the increasing expenditures have been essentially the response to expansionary fiscal policy, which actually means that fighting inflation will require restraint on the fiscal side as well. Okay? And that's something to be kept in mind given the current decisions that, for example, the Biden administration and Congress will have to make. Right? So Biden, of course, is being said as trying to emulate, FDR. But right now, what his main danger is to end up emulating Jimmy Carter. And what actually people might want to keep in mind is, I guess, the old Friedmanian rule, which, interestingly enough, became much more prominent during the Carter / Reagan years, that inflation is always and everywhere a monetary phenomenon. You may or may not disagree with that, but when you look at the numbers that we have emphasized, especially the size of the Federal Reserve, and remember the counterpart of the portfolio of the Federal Reserve is an increase in the quantity of money, then it is hard not to think about Friedman's very famous prescription. Okay, so what do I expect? I would expect interest rate increases of about 4, maybe more, Also, before long, I think that there is a high likelihood that the Federal Reserve is going to announce a calendar for shrinking its balance sheet. And on the fiscal side, the current version of Build Back Better is probably dead. Right? So I think this would be my predictions. Given that you asked for predictions, this would be mine. Okay, so this is what I wanted to say. I am from Peru, so one thing that I'm going to say is that I am not too worried about inflation. I mean, here, I walk around with two bills in my pocket. One is a bill of Peruvian currency, 50,000 intis, right? And another bill is a bill of $100 trillion from Zimbabwe. Actually, reportedly, this is the highest denomination bill ever printed, to remind me of the dangers of bad monetary policy and waiting too long, right? Because these bills would not buy like even a couple of eggs at the time they were printed, because these two countries had severe inflation episodes. So I don't think that we are there. To me, an inflation rate of 5, 6, 7% is not, in my experience, such a big deal. But it's something that we want to actually deal with, right? I remain optimistic. I think that COVID is likely to subside before long. The Federal Reserve and other central banks remain vigilant about inflation. I mean, that's something that I think we can be confident about. Fiscal expansion is probably unlikely going forward, partly because COVID is going to subside, going to reducing therefore the need for support measures and so on, and also because of politics, obviously. So I think that this is the positive message. Now, if you ask me about politics, we'll have to actually talk about that at a different time. All right. Thank you very much.
Okay, thank you, Roberto. Now, since we got started late, there's actually very little time left and quite a few questions, hands raised. So everybody, please keep your questions short and crisp. And the first person is Srikantan.
Hi, thank you. Thank you, Dr. Chang. A couple of questions. Some of the things you're talking about, it looks like smoke and mirrors, because when you look at the whole concept of quantitative easing and making easy money, we enabled bad actors on Wall Street to line up their pockets. So stock market is not the economy. So when you look at it, when you look at the income inequality, some of the other problems that are there, then of course the government tried the fiscal policy, the economic stimulus, all these tricks. So that's one issue. The other thing, like you mentioned, we talk about the inflation boogeyman. Is it really that bad? Then again, other point, people talk about, especially in this country, the taxation. When you look at in the 70s, 80s, the marginal tax rate was almost 80%. At that time, economy was booming, the country was built, things were going great. So maybe you can help me understand, what is this? Is this something economists have their own way of talking, Fed has their own way of talking? At the end of the day, the common citizen is end up holding the bag.
Thank you.
Do you want me to answer now or wait until?
Yes, go ahead and answer. Yeah.
Yeah, I mean, thank you for the question. About the fact that some monetary policy measures, like, for example, emergency measures that helped the country recover from the global financial crisis, might actually help, say, the richer segments of the population and exacerbate income inequality. I think that I completely agree. The question is what you are going to do about it, or how you're going to consider that. I mean, is that a reason not to do things the way that the Federal Reserve did them? We could spend a lot of time trying to think about these issues, but I don't have the time. But I would be happy to discuss that at a different time. About whether inflation is that bad. I think that at this rate, at this point, inflation is not that bad, but it can become much worse fairly quickly. I mean, you can see, you saw, the situation in the 80s, where inflation actually increased, quite fast, and this has a number of consequences for people, including. And also, it has a lot of political consequences. I don't want to overemphasize this, but when you think about what the impact has been on people's expectations about or feelings about the performance of the Biden administration, for example, then you have to be concerned.
Thank you. Okay, Jim Blinn, wait a second, I have to unmute you. There you go. Jim.
Yes, thanks for a very interesting talk. My question is, I noticed that the prior year inflation was down close to zero. And so I keep thinking, well, gee, over 2 years, shouldn't we be averaging the inflation from on a 2-year basis and say, well, gee, it's up 7% this year, but it was zero the prior year. So isn't that like a 3.5% rate over 2 years? So we shouldn't be quite so scared. What do you think of that idea?
I am not averse to that idea, except that what people are concerned with is not what has happened in the last 2 years, but what the situation is going forward, right? So the concern is not that inflation has been 7%. As you correctly say, when you look at the longer span of a longer time span than like 2 years, then the average inflation rate has not been that bad. But the concern is, well, if you don't do anything now to stop the acceleration, the inflation is not going to be 10%. It's going to be it's going to be 10%. It's going to be 15%, right? And then you are going to have a problem in your hands.
Thank
Thanks.
you. Mm-hmm. Alejo.
Dr. Chang, thank you for an informative talk. A quick question. What do you think will be the impact of cryptocurrencies on the economy?
Well, this is actually a very interesting question, because this is a situation where we don't really know that much. I mean, to some extent, we do have we have digital means of payments already, right? I mean, we have a lot of credit cards. We have like internet banking and whatnot, right? Now, what is it that cryptocurrencies actually add to the table is not clear, and it's sufficiently not clear that, for example, even now central banks are quite ambiguous about what they are going to do about it, right? I mean, just last week, the Federal Reserve has essentially established an initiative to start thinking about the creation of a central bank digital currency, for example, right? So my impression is that it's not going to actually change things much in the longer run. Probably it's going to change how things are actually done in the financial system, like but to some extent, much of it has been already has been done. Of course, there is a lot of press about cryptocurrencies, partly because of its spectacular performance, right? So that's something that we still want to understand better, and in particular whether there is actually real value in adding, say, Bitcoin and Ethereum and other currencies, or it is just like an old-fashioned bubble, right? Like the tulip mania bubbles, for example, of the 17th century.
Thank you.
Mm-hmm.
Rich Jager.
Is the amount of government spending and stimulus somewhat unprecedented in recent times, and does that call for different approaches, especially on the spending side, not just over on the Fed funds rate?
I think there is something to that. I mean, I think that expenditures were well warranted at the time when the big shocks actually hit the economy, hit the country. I mean, I think that in 2008-9, it was clear that at the time, in fact, the size of the fiscal response was smaller than it should have been. Right, it was at the time like $800 billion. Right, the 2009 fiscal package, and people correctly, I think, were asking for even more than that. Right. Also, with the onset of COVID, then I think that the response was appropriately forceful. But these responses also have to be temporary, right? I mean, they have to, they need to keep pace with the trajectory of the problem that justified them, right? And my fear in this kind of situation is that, once you have spent that much dealing with COVID, then there's the temptation to say, okay, so we spend, so much money, nothing happened, right? And the economy was strong. So let's actually keep doing that. So you have a lot of initiatives now saying, let's actually keep printing national debt until we have a problem. Well, right now we have a problem, right? So that's where I'm coming from.
Thank you.
Thank you. At this point, let me point out that it's 11:33, and we have more questions. If you can stay a bit longer, Roberto, we could go
I'll be glad to. Yeah.
for maybe another 10 minutes or so. So,
Sure.
Great. So the next question is from Bapi Sen. You have to unmute. There.
My question is, it's sort of a thing, the important thing is to move the averaging in right way. And it looks like if you move the averaging right way, you can fulfill your own prophecy rather than solving the real problem. How do you move the window of the averaging rightly? Is there a movement is right in the
Well, are you, if what you're saying is that there is the danger that the Federal Reserve is going to overdo it and essentially implement a policy that ends up causing a very large recession,
yeah.
and therefore creating the same conditions that it predicted. I can actually, after dealing with central banks and the Federal Reserve for decades, I can tell you that they are quite aware of that risk, right? So I don't think that there is a large danger of the kinds of problems that you are concerned with, of a self-fulfilling, say, recession, right? I think that there is all the likelihood that, as I mentioned in my talk, the Federal Reserve is going to move very carefully in trying to bring the inflation rate down.
Thank you.
Thank you. Ron Hoke.
Thank you very much for a very interesting talk.
Sure.
A question about the supply side.
Mhm.
It seems like supply chain issues are easing recently. I believe also that Intel has recently announced that they were going to build a chip manufacturing facility in the US. Can we expect supply issues to ease in the future? And what would the impact of that be?
Yes and no, right? Because some of the supply issues were directly related to the pandemic, like for example, shipping costs and whatnot, right? But there is a more longer term development, which is a lot of people have decided to leave the labor force, right? You may be familiar with the term, the Great Resignation, right? The fact that American workers are leaving the labor force and their jobs, in fact, in record numbers, right? And some of it reflects the decisions for early retirement of people, right? So those that actually means that essentially potential output, if you want, is going to may have fallen permanently. Interestingly enough, that development would say that inflation is more permanent than you might have expected at the beginning, because what it means is that potential output has fallen below actual output, which means that in some sense we are in an overheating trajectory already, just because of the supply disruption in this case. But the difference is that the supply disruption viewed in this way is going to be permanent, not transitory.
Thank you.
Jim Landwehr.
Hi, thanks. Very interesting talk. And you included a quotation from Milton Friedman. I remember studying him along with other economists way back in college, and his history of the monetary history of the US and so on. And my impression was that he sort of felt that, well, the quantity of money, the monetary effects were really very important, but that when people tried to adjust them and do things the right way, they inevitably screwed up and made things worse. So at least my recollection is he was arguing more for sort of a cruise control or steady pace and not try to do all these changes. On the other hand, the liberal economists where I was studying seemed to say, yeah, well, we understand that, but we know how to do things better now than we did in the past. So I'm just sort of curious now, how has that interplay or how are those views changed or reflected, or is there still these two camps and that's just the way it is? It's a little bit of a vague question.
Right. There's a lot of debate in the profession about whether Friedman was at the end right or wrong. For example, there is much less emphasis today on the quantity of money as opposed to control of the interest rate, right? And in fact, but I think that the danger is, well, at some point the quantity of money actually matters, right? I mean, you look at the Federal Reserve balance sheet, and if I tell you, well, it has multiplied by 10. Then the question is, at what point does this start mattering? And then by the time you recognize that, then maybe you're too late. So that's the danger, and that's what people are concerned with. This being said, it is true that before the pandemic, I guess that a main question was not really like the possibility of inflation, but the dangers of deflation in the long run. Right? I mean, that's what people, economists, not only in the United States, but more importantly in Japan or Europe, actually were mostly concerned with. So they were not as concerned with the increasing the quantity of money either. They were concerned about the possibility that we are going to go back to essentially the depression times of the early 30s.
Thank you.
Let me slip in a quick question myself now. How worried are economists about issues with regard to China? They hold such a large portion of our debt, and we depend on them now for so much of our manufacturing, and everything has to be shipped from China. And some very major areas of confrontation are occurring and bigger ones looming on the horizon. So do people worry about that?
I think that there is a fair amount of concern, especially in international macroeconomic circles, right? Because one important aspect of this whole episode has been that the Chinese economy actually continued growing, not as strongly as what one could have expected, but to some extent has provided some stability to the world economy, right? And right now, with the more recent developments, right, and also there has been some worrisome events in the financial system. I mean, there was, for example, this big, I guess, conglomerate that went into default, right? And people are very worried about that. And then a slowdown from the Chinese economy can have a lot of detrimental consequences for the economy, right? So I think that there is quite a bit of concern, but on the other hand, I think that we cannot do that much about it. I mean, it's mostly, I think the concerns are about internal problems and decisions of China at this point, right? And we have to wait and see what how these concerns are resolved.
Thank you. So Miguel.
Thank you. I did have this question before Jim asked his. It's a slightly different angle on Mr. Milton Friedman, going back to his equation. And I'm looking at it from a qualitative point of view. And if you take his equation, MV equals PQ, the point is to get P is the price level, MV over Q. So when you get a sudden shock on the economy, like the pandemic, and Q goes boom, okay, from a qualitative or a sensitivity analysis, that ratio increases significantly, which people interpret possibly as inflation. So the job of the Federal Reserve is to keep that P at a steady ratio. If it goes up, it's inflation. If it goes down, it's deflation. But the other thing is people at home, there's a question in here. The people at home basically, I think, increase the velocity of the economy. So you have a double impact, qualitative or sensitivity. Q is dropping like a rock. V is beginning to fly like a kite. So therefore, the price level is also elevating itself in inflation, which is, well, I guess, puts me on the temporary side. The chips are not going to come back because the chips that are being short, that we're short of, are the ones for which they're not going to build new machinery. They're obsolete. So, we need a big supply of old chips, not the new ones, not the AI chips.
So what is the question?
So the question is, do you think the sensitivity would explain the temporary case, and that is basically a passing readjustment?
Well, first of all, I'm going to disagree with something that you said, right? I mean, if I think about the MV equals PQ equation, and if Q drops, then this can be matched by a big drop in V, right? And an increase in the demand for money, which has been actually what has happened in the crisis periods that we have seen recently. I mean, when there is a big crisis, people have run into safe assets, right? And you can see that, for example, the amount of, monetary base has actually increased very fast, but essentially the multiplier dropped quite a bit, which reflects the fact that people were quite fearful of risks involved in the crisis. Now, the main question, so that actually allowed M, if you want, to increase that much, right? The main question is, what happens if you keep M at the same level and V recovers, right? So people start spending the amount of money that they got, and that's actually the main concern right now with these huge increases in the size of the Federal Reserve and the national debt.
Okay, thank you. So Steve Varley, you get the last question.
Okay, thank you, Roberto, for an excellent analytical presentation. Quick question, given what you expect in the way of the rise of Federal Reserve rates over the next couple of years, what recommendation might you have to Old Guard members who probably have a substantial portion of their portfolios in fixed instruments? Should they be tilting them toward short-term and ultra-short-term instruments?
Well, this is not my cup of tea. I'm going to say, I actually say, well, you have to do what I don't worry too much about these things, and I actually structure my portfolio so I don't worry too much about these things, right? I am a believer in essentially the power of the stock market, so I keep quite a bit of of our portfolios in stocks, right? Because there is something that has been historically a constant in the last 100 of years, which means that stocks have outperformed bonds by a very low margin. I mean, when you think about like 6%, it's something called the equity pathway, and that actually takes into account also situations like this. So, like, you know, I tend to be a little aggressive on the bonds side, but you know that actually exposes you to the vagaries of the stock market, and you know I'm willing to live with that. Now the question is, you know, if you are actually like getting more nervous about gains and losses in the stock market, then you should actually adopt a more conservative position, right? Meaning like shifting to bonds. I mean, it is just like a personal matter to me.
Okay, so you don't have a crystal ball after all. Thank you. So Arch, you're up next.
Roberto, we have two ways of thanking our speakers. The first is our certificate of appreciation. And
Thank you.
it's going to pop up here in a second. There it is. So note the orchid on the bottom left there. It's our symbol and logo. And as most of you guys know, the old guard adopted the orchid not long after our founding in 1930, as Summit, New Jersey was a leading producer and supplier of orchids at that time. And the second way we thank is by the old guard salute.
Thank you. Thank you very much. Enjoyed it.
Roberto, thanks very much for your presentation.
Thank you, Arch, and thank you everybody for your presence and your good comments and questions. I enjoyed it.